How opportune do you think this cycle will be for distressed investors? You've got a portfolio of investments. How are you looking at this in terms of basic opportunity relative to the last couple of decades in your experience?
Relative. We take a different view when we talk about distressed and turnaround. That's Drum Capital, that's all we do is distressed and turnaround, but do it through fund to funds, so it's a little bit different perspective, I think, than most people. We look at this asset class all year round, not just when we think the market timing is good and we should jump in, which I think is what a lot of investors will do from time to time. We tend to believe, based on the style of investing within distress and turnaround, it has a fit in the portfolio for a long-term basis, not just a tactical opportunity. In other words, I think very simply put, any company has a life cycle. Most companies I've come across have lumpy cash flows, especially in this market. There's growth and there's contraction, and in this market we're in contraction. But with that said, one of the biggest attributes on a characteristic basis for distressed and turnaround investing is the downside of the investment itself. In other words, something tangible, collateral. We look at companies and underlying investment strategies based on the style of investing that they're going to make, based again on the collateral behind that investment. Property, plant, equipment, something tangible, something disposable, something saleable, something that can generate cash. I don't have that in a buyout strategy that's going to look at the prospect of a company for the next 7, 8, 10, 12 years on a revenue growth model. So when we look at distressed, we look at it with sort of a two-tenet approach. One is, what's the value of the assets that we can acquire today at the current market price by buying the debt of the obligations at a discount? The second of which is then largely to, how do we get the company back on track? Fix the financials, fix the operationals. How do we get it back into a growth mode, a growth cycle? And I think if you, like we do, adhere to sort of a two-pronged approach to this asset class over a long-term basis, you generally have a lot lower risk than you're going to have in equity styles, whether it's private or public, and you generally exhibit fairly high levels of relative return, particularly even in today's market. As far as the opportunity set, we usually hope any given year for one or two industries to just unwind. A lot of different reasons, some systematic, some financial. In this environment, all of the above. And we're in an environment right now where I don't think we're going to see one or two industries unwind. I think we're likely to see some 34, 35 out of 36 unwind. And we're going through that right now. So it's a matter of price in this market. It's a matter of deleveraging in this market. And I think most importantly, which is the one aspect that's been overlooked for the last 7 years, as people reprice and have been repricing risk, it's now, again, finally based on the fundamentals of the company itself as opposed to the technicals.